Very cool interview today. I have Stephen Flood. He is CEO of Goldcore. We talk about the investment rationale for gold. He's based in Dublin, Ireland. So we talk about what is going on in the UK and Prime Minister Truss. We talk about gold and its rationale. And of course, we also talk about crypto. Links to, if you want to find out more about Goldcore or Stephen, go to the links below the pod. Be sure to click on them. And don't forget, subscribe to the podcast on Apple Podcast, Spotify, Google Podcast, anywhere you digest podcasts. Hope you enjoy it. Let's get started. Welcome to Jay's Corner. My name is Jay O. I am the certified financial planner. I'm also the author of Maximize Your Medicare, the published book. Jay's Corner is there to try to explain how certain financial matters work, to try to help you separate the signal from the noise, so that when something changes, you're not distracted wrongly, and instead keep your eyes on the ball, which is tough to do given the way that we are given information. There's a free and paid newsletter. Go to jo.substack.com. There are 2 YouTube channels, Jay's Corner, as well as Maximize Your Medicare. Be sure to like and subscribe to this podcast on Apple Podcasts, Google Podcasts, anywhere you digest your podcast. Be sure to leave your comments. Let's begin. Welcome to Jay's Corner. Today, we've got a special guest. Usually I'm the one being interviewed. Today, I get to interview. We've got Stephen Flood out of Dublin, Ireland. He is the CEO of Goldcore. Stephen, welcome to Jay's Corner.
It's great to be here, Jay. Thank you so much for having me on.
You know, most of our audience, as most of the press, dominated by American companies and countries. Well, the fact is that as an American, we're dominated by American-centric news. So now we've got you who are obviously in Europe. Can I ask you, what in the world is Prime Minister Truss doing?
Well, in my view, she's kind of making it up as she goes along. She got very excitable about the prospects of being in power. She probably didn't expect for that to happen to her. So she has... So when she was campaigning against Rishi Sunak, I think the snippets I heard of her, she basically promised everything to everybody. So everybody gets sweets, everybody gets everything they want, and she never was challenged in terms of how she was going to deliver it. It reminded me of Al Gore losing the first general election when he started talking about the Social Security lockbox. And right. How he got caught up in the maths of what he was talking about. And Bush, too, would just say, hey, I'm not going to talk about any fuzzy math. I'm going to talk about, that hard-working blue-collar man out there and that woman, and I'm going to talk to you. I'm going to fight for you. And that message went right past all the math and all the boring detail. But the boring detail matters, as the markets showed the UK government. So I think she promised everything, had no plan to deliver anything, is sitting there in the hot seat now and has been found out hugely and has lost a massive amount of credibility, which is very sad for the good people of the UK, the hardworking people of the UK, because they've had, I think it's 4 prime ministers in 6 years, which is incredibly destabilizing, and I think goes to the heart of it. But my own belief on this particular point is this is not unique to the UK. This is a global phenomena. Yeah. It's born of free money, where you don't have the reckoning that comes with a set of accounts. You have to balance your books. And if you can't balance, then you have to have a very, very robust argument to say exactly why you can live with a deficit for X amount of time and what you're going to do about it. So ultimately, the debt markets work as this kind of balancing mechanism. But when you have a bad actor, such as central banks and treasury departments coming in and buying up bonds in order to maintain a narrative that is politically necessary, you deny the market, you deny the people the right to pass judgment on policy. And so therefore you get a very, very poor quality leader, poor quality administrations in power for extended periods of time. And to me, that is an absolute tragedy, because we know where this goes. We see history. We know what happens when you have money printers in charge. And ultimately, it turns into despotism. It turns into inefficiency. It turns into corruption. and we all lose. And eventually, and I hate to say it, people die. This is what happens. It's real.
Let's say that you and I aren't going to fix the world, in our conversation today. Let's pretend that that's going to be the case. So that does dovetail well with what you do, your role, your company, Goldcore. Why don't you tell the people, our audience, what it's about, your size, and the services you offer?
Well, our purpose is to be the best company for people to go to buy precious metals and to store precious metals as safely as possible. Very important, the idea of storing it. So we allow our clients to open up accounts very, very quickly, about 3 minutes, believe it or not. Our technology is quite advanced. And they document themselves, they can open up their account, they can then fund their account, and then they can purchase precious metals. And all the way through that process, we make it as easy as possible and as safe as possible. We allow people to store metal in, I think it's 11 vaults around the world. The metal is stored on a segregated, allocated basis, which means it goes on a shelf. You have an account number on it. It's your account number for that particular bar. Nobody else's metal is mixed up with yours. It's not on our balance sheet at all. It's only your metal. We don't own it. And it's there in a safe jurisdiction. And you decide which is the safest jurisdiction. You can have one or many. You can have it stored in Utah, in the North America, or Toronto, or New York, or all the way in Zurich, where our biggest vaults are located, where most of the assets are. We also have Dublin, Ireland, and the UK. So all around the world, clients basically have a favorite or they spread it around. We've been in business for 18 years. We just do physical metal. That's what we specialize in. We work with all the big refineries, all the big mints, and we're very, very well respected. We're most proud of our record with our customers. We have a 4.9 out of 5 stars over 12 years of ratings. And all those ratings are public and they're on our website, and we don't get to control them. They're raw. They're exactly what our clients say. And we're really, really proud of the actual relationship we have with our clients. We're massive advocates for honesty, integrity, and amazing service. And I'm not just saying that. The team here are exceptional.
We see a lot of advertisements, banners on the web, internet, and things like that about gold. Why don't we, for our audience who are newcomers or don't, specifically know the rationale for gold and its place in someone's personal savings portfolio, retirement portfolio, investment portfolio, what role in your mind do precious metals play?
Well, I love that old Wall Street adage, and I think it says it better than anything. I love simple statements. Put 10% of your money into gold and hope it does not work. Okay, so if you have 10% in there and it goes down in value, everything else you own is going up, and that's a good day. That's great. So I hope you buy gold, and I hope you lose money, and I hope it goes down in value. And I think if you understand that and you become a customer, I think we have a great relationship, because you know what it does, its purpose in a portfolio. It's not about making a return, even though I expect it to make great returns in the future, but not for the reasons other investments do. And I think what it does is it gives kind of financial sovereignty to the individual over the system. And I think the system is very much rigged in favor of large corporates. We have significant amount of monopolies in operation right now. The financial system, the banks, the regulators are absolutely captured by special interests. And I think we have a significant amount of inequality in our system over many, many years, over decades now. The poor are getting poorer on a relative basis. And I think the rich are getting even richer. And I think it's going to end in tears. So I think when you own gold, its purpose is to bring stability to a portfolio, to give sovereignty to the individual, to have something that cannot be printed, and that something is physical and tangible. And I don't think any other asset comes anywhere close to having the properties that gold and to a lesser extent silver bring for an investor.
We've got your statements there just opened up, hours of conversation, hours, literally.
Sorry.
But let's just focus on what you said at the beginning, which is the role and the fact that you're happy when the other person understands the actual function, meaning that you're happy when people don't make money in gold but out of that 10% because it's told you that it's been stable, allowing other parts, meaning the function.
Yeah.
Do you think that that's well communicated by yourselves? That, everyone's chasing glamour and glory, right? Meaning, it doubled, it tripled, it quadrupled. I bought Amazon at $1 a share. But gold and its role in a portfolio, very, very different in that sense. Can you speak a little bit more to that? Meaning that how do you go and work with a client to try to explain them, to educate them? Or do you think that they're already educated by the time they approach you?
No, not at all. No. Most people are, it's a fascinating question. And I'd like to say all of our clients are very much on board with what I said. They're not. Many of them would be chasing a kind of a contingent valuation, whereas they think a number of things are going to happen in the world, and then this is going to be a winner. Some of them have it as part of a portfolio. Some of them have more than they should in it. I'd like to see it. I'd like to see them look at assets, productive assets, more constructively, and see it as a good kind of bedfellow. But unfortunately, that's not the case. Human beings can be quite linear, and they can be
that's
quite,
for sure.
Insecure, but also they follow too closely some people, and they're followers. They might just decide to follow a smart person in their group, in their social network, or somebody on the golf course says something, and that's all they need to know before they jump in with 2 feet. And they don't realize that wealth comes from really having a kind of a discipline to money and to investments, and looking at kind of cash flows, and looking at how to protect cash flows, and how to distribute cash flows. So looking at tax, looking at pension, looking at distributed, proper portfolios that take on account their view of risk for where they are in life. And I know it sounds really boring, but that's actually how you play the averages over time. And so we think gold fits perfectly inside there. But then on the other side of the coin, investment professionals, you're a CFP, I'd say 95% of investment professionals have no idea what gold is, or what it does, or what purpose it serves. And mainly that's because it doesn't pay exorbitant commissions to the industry. It's boring. It doesn't have cash flows. It doesn't actually do anything. It sits there in an inanimate way, and it just costs money to store. Like Buffett said, why would I buy something that just costs money? You might as well dig a hole and bury it. So I think all of them miss the purpose of gold, which is it's actually money. It is money. It's a unit of account, and that's what it is. That's its purpose in a portfolio, and you need to focus on your education. Number one, before you put a penny into gold, is educate yourself. Spend money on education, and then build a portfolio of cash flows, and then add gold as a protective layer, a foundational asset. Like you build your house, you put proper foundations in place. That's what gold is. 5, 10, 20% is not unheard of. And I would argue today in this world, 20% is probably, a starting point in some ways. And I hate to say that because it's there to protect the other 80.
It's so interesting because, and full disclosure here, Stephen. So to the audience, we didn't have a script. I didn't tell you what questions. And the funny thing is that the viewers, the followers, the subscribers to Jay's Corner have seen me tell basically your message with almost crazy amounts of similarities, meaning not one individual line item in isolation, but across a number of different matters, like you said, measuring cash flows, tax efficiency, storage, et cetera, depending on the individual function. So fascinating. And, I'm glad we're separated by an ocean, but we have that in common for sure.
We're like brothers from a different mother.
Right. Let me ask about the fact, you mentioned the fact that you are storing precious metals physically. So it's not only gold though, right? It's silver as well. Is that right?
Yeah, silver, platinum, palladium, but like 90% of what we do is gold and silver.
We'll talk about, I will have some questions about silver later, time allowing, but let's talk about the fact that you are physically storing. So can this gold actually be delivered to my house?
Yeah, absolutely. Yeah. I'd say maybe 40% of the time we're actually delivering gold to people's places of work or their addresses. About 60% of the time, it's placed in vaulted storage. We deal with our minimum is about $5,000, so we don't do single coins and single small bars. And we try to get the clients into the lowest premium product we can, which is important, and because we want them to have as much value as possible. We want them to be a client for life, and we'd like them, if possible, to advocate for us amongst their network of friends and family, which happens more than you can imagine. That's how we get most of our clients. And so yeah, so it's delivered or it's stored in vaults.
If your rationale holds from the beginning, your explanation, your investment rationale for a partial allocation to precious metals is correct. Let's presume it is. It makes total sense, especially given the incredible amount of policy-induced volatility in both, which is now a door which people thought only swung one way, but actually swings two ways, right? Clearly. Why wouldn't I choose another instrument? Meaning, there are ETFs in the United States, GLD, SLV. There are futures markets where you have contracts, very liquid. Why is it the physical holding, in your mind, your opinion about why that would be the way you would allocate, as opposed to using an ETF of GLD, for example?
There's definitely a role for those as well. I kind of split the market into, or our client, well, not our client bank, there's the market for gold into speculators and investors. Now, speculators have a much shorter term horizon. They very much care about the cost of ownership, the buy cost and sell cost, or the spread, and the cost of actually maintaining a position. So they want those to be as low as possible, and they give up a number of rights and in order to have the convenience of getting into the market quickly and out quickly. So they're trading technicals, levels, and they're looking at complex relationships in the market. They might see a dollar index over undervaluation, and they want to buy metals to really kind of to increase their returns. So they should definitely look at derivative contracts or whatever costs them the least amount of money and gives them the most amount of exposure given a particular trend that they're looking to take advantage of. Now, that's great. But if you're an investor and you're looking at gold as a kind of a systemic hedge, the actual physical form of that investment is actually way more important than the costs. And that sounds a bit crazy, but I think it was Greenspan who said that gold in extremis, in extreme circumstances, is accepted by everybody, whereas other investments may not be. Now, I'm probably destroying that quote, but that's generally what he said. So physical gold for delivery, immediate delivery, is going to command a premium. And so we see this actually all the time. So investors like to have physical gold that's in a vault, that's stored, and it's outside the financial system where they believe the systemic risk will come from. So it's a bit crazy to have a hedge and have that hedge inside the system that you're trying to hedge against. So that's the main argument for physical gold.
Excellent. It's an excellent point. I'm just out of curiosity.
Yeah.
And we've seen this on occasion when financial markets are under great distress. Meaning, and if I just take GLD, and I don't have a interest in GLD specifically, but it is just the most well-known of the ETFs for gold, clearly.
Yeah. Yep.
Do you have concerns about systematically, right? Because construction of an ETF is still ultimately based on, order flow, right? The number of shares of GLD that exist. And then whether it's actually backed by the gold itself. We'll talk about futures separately in a moment. That, at certain times of stress or somewhere under certain theories, that the amount of gold that actually is outstanding is either much more or much less than otherwise reported. Do these things keep Stephen up at night at all, or we should just blow them off and disregard?
No, I definitely don't think you should blow them off and disregard them. I think what you need to do is do your homework and look at the prospectus. And the prospectuses are great. They actually have an awful lot of information in them. And they tell you pretty much what the risks are. if you look at the prospectuses for a lot of ETFs, and I won't talk about specific ones,
Sure.
but you'll find that the promoters and the operators of these structures are indemnified should anything go wrong, which to me is quite informative.
Right.
That is to say that if the gold takes a walk or goes away or wasn't there or there was fraud or directors were fraudulently operating, there's no recourse back to them by the beneficiaries of the fund.
Well, let me just, if I can interrupt just one,
Yep.
That's not to say that we're casting doubt on whoever the sponsors of the actual ETF are, right? The State Street is there. So, well, to the innocent listener, I just don't want to have that implication left out there. You understand my point, right?
But it's
to professionals like us, we understand that. To individual investors, they may not understand this distinction. We're not disputing the accuracy or the fact that the contract writer is going to deliver on the contract as it is written, right? I think
I'm not identifying any particular ETF either. I'm just saying, generally speaking, if you look at prospectuses,
you got it. Right.
You will find that these indemnifications are in place, and this is the terms by which people engage with these products on.
Yeah.
And if they're happy with the risk, I'm happy for them. There's no problem there at all. But my point is that if you again, going back to the systemic hedge, if you're looking at this as a speculator, I think those risks are very, very low that you're going to get caught out. I think you're probably going to be okay. But if you self-qualify yourself as an investor and you're looking to reduce systemic hedge risk, that is another Lehman Brothers style event or a currency collapse or a global debt crisis, what you need to look at is the second and third order events that could happen and compromise whatever ETF or structure that your system hedge is placed in. So
I'm with you.
You need to look at who the promoters are and how they hold it. And I would argue 9.9 out of 10 that you can't improve on having physical gold in a vault in Zurich outside the bank system. I mean, it's just, to me, that's exactly where you need to be if you're looking to protect against those risks.
No, that's fair. And I'm not trying to dispute what you're saying. I'm trying to tease out to make clear, what you and I are talking about, because lots of persons are very highly suspicious. They think that the writer of the actual contract of the ETF prospectus is doing something insidious, above and beyond what is on there in print. They're not. It's just that the other stresses can create these situations. And like you point out, there's indemnification clauses in there to say, look, under these types of situations, investors wearing these risks, whether you know it or not, even if low probability. That's all my point, right? If I switch to futures, and I realize we're getting deep in the weeds, this is probably a different line of questioning you probably anticipated. In oil markets, for example, there can be certain points in time, for example, where there's a futures market, obviously, and there's actual physical delivery. And then, in the past, because crazily what happened during COVID, there were delivery problems, right? There are delivery and storage problems that can occur in oil. Are there delivery problems on gold futures contracts? And Jay the nerd is asking, for finance bugs. First of all, I'm not sure what the settlement is of a gold futures contract. And then in addition to that, are there delivery or storage costs, et cetera, built into the delivery? And how does that work out?
Well, I'm not an expert on the delivery side of futures, but pretty much most of them settle for cash. So they settle upon expiration or approaching expiration. So they neutralize and then they roll over to the next dated contract. You do have the right to take physical delivery, depending on how you purchased your contract, and those deliveries are made out of the vaulted facility attached to the exchange. Now, there have been issues in the past with delivery of gold contracts, whereby when COVID hit, there was a dislocation in the global supply chain. And it was the exchanges had difficulty in guaranteeing the supply of physical to settle contracts because they couldn't move the gold to where it needed to be because they had a distributed ownership.
So that's what I was asking. Exactly.
Yeah, the bullion banks in London needed to have the gold not in London but in North America and they couldn't get it over there through the airline system. So there was suddenly there was a huge dislocation in the price. But the powers that be, they were able to change the rules in terms of what constituted delivery for formatted purposes.
I see.
And they're able to settle that problem. So there have been issues in the past. I'm not an expert in it, but pretty much the futures market is an interesting beast. There are strong opinions that, again, going back to printed money and the markets and how true they are. Right. There are special interests, or there's a belief that special interests can manipulate key markets through the futures markets by using massive leverage. So you could put 5% down and get 100% exposure. Right. And you can move these contracts at certain times in the day in certain markets when there's lax liquidity, and you can create a news event and damage the fundamentals behind the market. And I would say the jury's out, but for some people. But I would think, for me personally, my opinion is that the gold market has a significant amount of bad actors in it who operate through various different ways. But ultimately, they can knock the price of gold down, even though the fundamentals are very strong and supportive. And they may do that because, for political reasons, if you have a Treasury Secretary or a Minister for Finance out in the open at a press event saying everything is fine, there's no problem here, please move along, and suddenly the gold market jumps 10, 20%, that could make a liar out of them. So I think a lot at the very higher end of power, they don't like to see the gold price make a fool of the story, the rhetoric that they're delivering to the people.
Here's a good place for a break, Stephen. We'll be right back, and we'll talk more about what you just said about the political machinations that exist, and again, it's the usefulness of precious metals in that context. So, Stephen, back to kind of our general audience. Like I said, when you're an American like I am, born in the United States, dominated by news based in the United States, but the reality is now a wake-up call about the goings-on as a result of Ukraine and Russia, the effect on energy. And maybe you could tell us, and I know you're not speaking for the entire continent, right? But overrated, underrated, properly rated the energy crisis in Europe as you can see, as depicted and being delivered to us.
Right. I think it's brand new territory for the world. We've never seen something happen so quickly like this in such a way. I mean, the world is an integrated economy. I mean, we have globalization, and if you look around wherever you're listening to this podcast, in a car, in your office, whatever it is, the objects around you have been sourced from 100 different countries. The components, the skill sets, and we get great benefits from that. We get cheaper product, better quality, better fit. But the counterpoint is that we have greater dependencies on these places to provide the components. Right. So now you're seeing a situation for the first time where, like, you can't buy that car, or the car this year has less features than the car 3 years ago because the chips aren't there and we don't have the expertise. And now we have a concept called nearshoring coming in. So the US are bringing forward, Yellen is, where you source things only from those politically friendly nations to you and your home markets. That creates inflation because those things cost more than they would elsewhere. So we have inflation being baked into our economies going forward. People are going to have to spend more money. Now, the energy is something we've been taking advantage of cheap energy for so long, and the Germans have been taking advantage of super cheap energy. And also the other side of it, they have a much cheaper currency by which to sell their heavy engineered products and specialist products all around the world. And they've benefited massively from this. So the euro is a much cheaper currency to export with than the Deutschmark would have been. And they're the engine of Europe. Right. And people don't realize that they have the German economy has just done so well. But the European economy is massive. It's like, I think I was surprised, actually. I didn't realize this. I'm embarrassed to say there's about 700 million people in the European economy. And
just basically double and a half of the United States for people who are keeping.
Yeah, right. It ain't small. Yep. It ain't small.
Right.
Okay.
Right.
It's big, and it's advanced, and it's deep cultural value to it. It's just an amazingly fabulous place. Can I just say, and I don't mean to be rude here, but
You're not.
I lived in America for many, many years, and it's night and day between an American citizen who has traveled in the world and one who has not, or who one sees the world as being represented through their television screen or social media. It is not representative of what's out there. Travel, get out there, go to Europe for a few weeks and go through the cities and just drink it in, because it's fabulous. Ireland is the best place of all, of course.
Right.
But no, but like, experience it. But when you ask me about the energy crisis, it's I think it's very real. It's huge, and I think it talks about globalization, and it's a lesson for the rest of the world as well. Energy has been weaponized. It has always been weaponized, but it was always used by the Americans, at least, as a kind of a soft power tool. That will give you access to the energy markets, the oil markets, and and our banking system and our insurance will follow. And it was a way of kind of building empire softly through economic power. But now it's been used in a military context, and no one's equipped for this. So we're now figuring out what to do. I think it'll bring resilience, a little bit of resilience into us. It'll wake us up in many different respects. I think the lessons from energy in Europe, what's happening, will manifest now in manufacturing. It will manifest in insurance, risk mitigation, financial products. This counterparty risk argument is now very much at the fore, and sovereigns are now joined the counterparty risk argument too. You can't necessarily trust your sovereigns that you work with. I think it was De Gaulle. De Gaulle said, countries, they don't have friends, they just have interests. And this is so true, and I think that's what's happening now in Europe.
You touched on something pretty that I wanted to go and discuss as well. So to you, person in the United States, we see, cars, for example. We have Toyota, Honda, Hyundai, Ford, General Motors, Volkswagen, let's just say, and there are more European manufacturers. And the euro this year, a problem. I mean, a real problem, right? I mean, we went from 120 down to below par in very, very short order. Can you talk about the stress this is creating in Europe for general people, for everyday people?
Well, it's interesting. It hasn't created the panic that people would maybe have expected.
Really?
Or they're going into the winter. It's not quite there. It's there. What's happening now is that the tool du jour, the favorite weapon of money printing, is being rolled out, and governments around the world are using debt to soften the blow of higher energy prices by capping the price that consumers will be exposed to. Now, it's an extraordinarily dangerous thing to do.
Combination.
Yeah, on so many levels, because they're I mean, there's so many ways I can explain it. Basically, they're giving up the future cash flows of the state in order to protect the energy needs of the people short term, and by doing so, they are perpetuating a cycle of kind of fiscal destruction, and they're passing the buck to the next generation at an unbelievable rate. They also then bring in, they open the door to more extreme political actors to continue this policy and promise again everything to everybody, which is what you're seeing in the UK. And ultimately, we all pay the price. This is an attack on capitalism. It's an attack on capital creation. Yes,
that's true. But aren't there limits, right? I mean, there are limits in the sense that, right, you can't keep doing that forever, or not even necessarily to too far an extreme, because then your currency, then it gets reflected in the value of your currency. No,
it does.
You see what I'm saying? I mean, in other words, right? The British economy learned quickly what the jury was when on the newest fiscal stimulus from the new prime minister, and nailed the pound. It's since recovered, right? But the first reaction was to immediately sell that currency. Wouldn't the same thing happen around the world if these extreme situations, like you say, play themselves out?
Oh, they will do. I mean, in my opinion, all currencies will eventually go to zero. That is the ultimate price level of currencies because they're being debased. They're being printed, and it's not so much the price of things are going up. The stock market isn't going up as much as the currency is going down. That's a big part of it. So we have competitive currency debasement right across all currencies. That's why.
Do you think that's intentional?
No, I don't. I think it was intentional by the US when they brought in QE, and they did it for very kind of myopic reasons to protect their own base. But what they did was they created this knock-on effect elsewhere in the world where other currencies had to be debased the same rate in order to protect.
But that's currency war, right? What you've described is basically subtle but intentional currency war, isn't that?
Well, it is, yeah. If you don't do it, then your exports become ridiculoly expensive relative to the largest market in the world, and all your other competitors are going to do it versus the US. So they all have to do it together at different rates, albeit. But it happens. But ultimately, what happens is our unit of measure, our means of exchange, gets debased, and that means that you're getting taxed again. So if you work hard and you get paid, and you pay your taxes, and you put into a savings account, those savings get debased. The rule of 72. I don't know if you ever heard the rule of 72. It's quite popular with in financial circles. Basically, you divide the inflation rate into the number 72, and that's the number of years you have before your money halves in value. So at a 10% inflation rate, your money will halve in value in exactly 7 years. This is crazy. You spent your whole life, creating these savings, and then they get taken away by virtue of money printing. I don't blame the Ukrainian the inflation monster that we are dealing with today is not purely as a result of war in Ukraine. That was the trigger that affected the actual crisis. It had started 10 years previous when they started the process of printing $20 trillion of currency, and it did not.
I'd say even down. Before that. I mean, and what you're saying is exactly dovetails. I mean, which is that that Ukraine, as tragic at it on a human level, just kind of like the catalyst to kind of hit the gas, no pun intended, right? But to really be the catalyst to the process as you've just described. So back to your goals. So in that construct with that backdrop, and here's where I wanted to, start this line of questioning and, this discussion with you, which is this should be right up your alley and Goldcore's alley, right? Because what you've described should have played out, and maybe you can tell the audience who is not necessarily aware, right? Because this has played out for persons who are denominated in euro straight into exactly what you've been recommending.
Oh yeah, I mean, it's insane. I mean, I think it's since 2007. The last 15 years. If you look at currencies across the world, now this is incredible. On average, all currencies have appreciated in gold terms by between 7 and 8%. So gold has appreciated on average 7 to 8% every year since 2007, which is absolutely incredible. Now, I'd argue that it hasn't gone up; those currencies have gone down by that amount. This year alone, so far, the euro gold is up it's up 8.2% in euro terms.
Right.
The dollar, it's down 6%. So dollar owners of gold are feeling a little bit of pain. The dollar has actually strengthened relative to every other currency in the world. It's doing so because money is flowing into the dollar as a safe haven.
Sure.
So typically, and this is just my opinion, when you have safe haven demand coming in, it goes into the most liquid item first, which you can readily get your hands on. Dollars are easy to buy. So money flows in there. It leaves emerging market debt markets, and those countries then suddenly have a financial crisis on their hand. They can't finance their operations. The money leaves those places who need it the most, goes into the dollar treasury market, who don't need it. And as a result, the dollar becomes very, very strong relative to those currencies. So what you then see after is if it becomes a structural, what we call risk off, people go, you know what, I'm going to sit the sidelines here for the next 3 or 4 years and go on holiday, go away in May and come back again in 5 years' time, not next year,
right?
Or the end of summer. they're going to start shifting into things like gold, away from the dollar, away from the yen, and other places like that. Or gold will be part of that portfolio, and I think gold will appreciate markedly. No guarantees. I can't tell you that's going to happen. I don't know for sure. It's just an opinion. But I do think that, in our own business, and we're a small microcosm. We've been around for 18 years. We've got customers all over the world. We manage around 300 million in assets at the moment. We're seeing extraordinary increases in demand for precious metals accounts. They're up quite a lot, 30-40% year on year. But the gold price is very cheap still, which is great. But when we started this business 18 years ago, the gold, I think, when we started, it was at $350 an ounce. It's at $1,700 today. But in British pounds, in euros, in Aussie dollars, gold is at or near all-time highs. And it's doing so because it's doing exactly what it should do.
If you're domiciled in the US, you live in the United States, any and I'm not, and again, as all of our conversation, I need to swerve and say this, right? Today's not investment advice or financial advice of any sort, right? I mean, this is just two people talking about, the dynamics that are going around the world. But I've seen on your website, for example, a US investor can actually open an IRA with you in there with their qualified funds. Is one of those, can they switch into euro and then purchase the gold in euro terms, meaning that maybe they think this reverses? I just don't know. I'm just more perversely curious.
It wouldn't make sense. You have to, your home currency is your home currency, and that's what you record P&L in. I wouldn't advise anyone to go from dollars into euros and euros into gold, because they're just going to pay a kind of a carry cost, a conversion. And it probably wouldn't be a good idea. But I would think that for US investors, the idea of owning physical metals, if you haven't done so before, do so. If I could shamelessly plug a guide we have, it's not commercially orientated, but again, over those 18 years, we've seen an awful lot, and we watch our competitors and we watch what they do. And there's a lot of people out there you shouldn't buy gold off. Essentially, I think anybody who's advertising on television, or anything of those expensive mediums, you should be very wary of. I'm not saying they're all bad, but just be careful, because there can be, sometimes they sell you very expensive versions of gold, where there's a lot of other really good dealers out there that you should probably look up. But in our case, we try to get the lowest possible premium product. A premium is the price you pay over the spot price of gold.
I got you.
And that takes into account the format, the complexity of what you're buying. So buying kilo bars is one of the cheapest ways of owning gold. Storing it in Zurich or one of those places is one of the best places to store it. With your IRA, it'll be stored in the United States itself. It has to be stored domestically. And we do that as well. We also have two offices actually in the US. We have one in California and one in Florida. And we just opened up recently, and we have staff members over there too. But when you buy from Goldcore, you're buying off Goldcore Ireland. We're actually doing the transaction with you. We have dollar accounts in the US, so you can settle with us very, very quickly.
Right. So I'm pretty sure I know what the answer is, but I'll let you have your shot at it. So, your rationale about, country versus country, and not to say that it's war, but the fact of sovereignty and the fact that the currencies, are devaluing, this same rationale exists when someone talks about Bitcoin, right?
Okay.
So how would you contrast as, even-handedly, I'm sure you're going to start with a bias, right? Which is fine. Entirely fine.
We all have biases. We all have biases.
There you go. I think the Michigan Wolverines should win every week, and so should the Dallas Cowboys. But anyway, that doesn't happen.
Buffalo Bills all day long.
Okay, I was born in Buffalo. That's a fact that
my wife's from Buffalo.
Anyway,
go Buffalo.
You could make the same rationale. You've heard that same rationale. Similar rationale, which is, countries debasing, can't trust the governments, they've got debt explosions, etc. Printing press. Contrast that from your perspective with crypto.
Yeah, I mean, like I think it's fascinating. The Bitcoin brigade, they have Bitcoin itself is a response to the same anxieties that have irked people who buy gold for many, many years. They are wishing to protect themselves from currency debasement. 95% of the people on your street, in your company, in your neighborhood, don't have a clue what's happening to the currency. They don't understand that money printing is rife. People who own Bitcoin, people who own gold do. Now, where they differ is Bitcoin is a currency which is used for transactions, but the technology has become antiquated very, very quickly, and they're desperately trying to improve it and improve how fast it operates with new upgrades and whatnot. Whether it's successful, I don't know. I do think that there's an awful lot of people in that community who actually look at it as a marketing opportunity and they pump it up for all sorts of emotional reasons. And I think you have to be very, very careful about those people. I don't think, my personal belief is, I don't think Bitcoin will ever become a currency in popularly use, because currency is political, and politics is power, and those in power will never allow something to usurp them and their power base. So they'll kill it. They'll associate it with pedophiles and terrorists and Russia and Putin and everybody else they can as something to be avoided at all costs. And so they will kill. I think they already started. I see headlines. I'm waiting for these headlines to come in, and I saw that they were associating with the Russian armed forces there recently. And it's, buy Bitcoin and you're part of this, and it funds that, and they're bad, so you're bad. So I do think that central bank digital currencies will come in, and they will take over the space inhabited by crypto today. Crypto is a technology experiment. Fascinating, love it. I think it's amazing what they've done. I think blockchain is the real story behind that, and that will change the world.
No question.
It's a 1 in 1,000 year technology, and I think it's just brilliant. And I think it'll bring so much utility and save so much waste. It'll be great. I think it's going to change humanity.
I was playing golf. It was a month ago, and the people I was playing with, they were not financial persons, but I just said rhetorically, I'm like, I have no idea why these title, firms exist, given the fact that we can have this thing stamped with blockchain and it's 100% authentic, 100% traceable. Why do these middle people exist? And I'm not sure. I'm sure I made some enemies just in the last 30 seconds. But literally,
it's the same as ETF. It's ease. These are regulated entities. You can buy them on your phone in 2.5 seconds.
Right.
What are you really buying at the end of the day? Do you actually own what they sell? I don't know. It's and do you own it in all conditions? I don't know. It's a proxy. I call these things proxy. There's proxy of gold, and there's probably proxy Bitcoin. It's just simple. They go through the regulatory channel, and it makes it easy to get to as many retail investors as possible.
No, what I'm saying, maybe I wasn't clear. Let's say I sold you a plot of land, and now you own the title to the land. We've got to go to a third party who's going to certify this title now, right?
Yeah.
Why can't this be simply transferred via blockchain technology?
Well, this is a great question, and I apologize for confusing my response there. But basically, if you look at the way we organize ourselves as human beings, we use technology that's based on ancient protocols from the time of Babylon.
That's
characters on a page.
That's my point.
Yeah, it's so, and we don't, and your page with your characters on your page, I don't trust it. So we have to find a third party to help us. We need a trusted middleman, and that's a bank, that's a tax advisor, that's an accountant, that's a regulator. And these people are there to build trust between you and me and other people, because we don't trust each other. And we spend so much time, securing the security around ownership. So blockchain is mathematically rigorous, and therefore we can rely on it to prove that you have the money and I have the land, and that's all we need. And so that's what it's going to do. It's going to have a massive deflationary effect, change the professions all the way through.
I would think
but
so.
It's also going to unleash so much excess human capital on problems that really matter. And I'm a big believer in climate change. As a lot of people aren't, but I am. And I think that's what we need to be focusing our attention on. And we need to create amazing energy systems and infrastructure to help us grow and flourish. So, yeah.
Well, Stephen, I think here's a very good breaking point. It's been Great to talk with you, and hopefully you'll join us again, be a regular guest. We can have these conversations, on a frequent basis. I'd love that.
I'd love that too, Jay. And also, I'd love to have this broadcast on the Goldcore channel too. And we're going to put your show notes into that video. For me, anyway, if anyone's finding out more, it's goldcore.com.
Absolutely.
And that website, there's a special website we have for that guide I spoke about earlier. So if you're interested in gold, you've never looked at it before, you don't know anything, there's a guide we have, and we have a special website called goldintheusa.com. You just go in there and you can download goldintheusa.com. If you want to open an account, it's goldcore.com. And your show notes are your where people find more about you and what you do.
What we'll do after the call, we'll be sharing all of those links, details, etc., so that everyone from both of our audiences can share the information in our conversation today.
Super. Brilliant.
All right, Stephen. Have a great day. Thank you so much for joining me on Jay's Corner.
Thank you so much, Jay. I really enjoyed it. Thank you.